All right, we're back, Matt. It is the month of December. We're back with the market update, and there has been some big news today with the Bank of Canada cutting their benchmark rate there. And I want to jump into it, but first, how are you doing?
I'm good, buddy. I'm doing good. Little surprised by the rate announcement today, but you know what? The weather's been brutal this month. I've just wanted to hibernate all month, but I look forward to our chats once a month, so I'm ready to jump into it.
I've had multiple conversations this week with agents saying I'm just tapped, I'm done. I don't know how I'm going to make it the next couple of weeks, but there's that everlasting reminder. It's another week and a half to go. And like you said, I always look forward to our chats. So let's dive into it. The Bank of Canada has made another cut, and it's a big one. We're looking at another 50 basis points, which brings us down to 3.25%. And before I get your take on it, I want us to talk a little bit about what the anticipation was, what we were expecting, because when we look back at this data that we had on November 15th, everybody was leaning 76% towards only a quarter point cut, leaving us at 3.5 instead of the 3.25. And now obviously we've seen a change in that, and there's been some other updates along the way. So just talk to me high level, what happened between November 15th and today that now we're sitting here with this 50 basis point cut?
Yeah, I think there was quite a few things that actually all kind of compiled on to give the Bank of Canada and sway the economists into believing that we were going to get a 50 basis point cut this month. And one of the first ones was the government came out and said that they're going to slash immigration. And that has an impact on GDP. And the Bank of Canada, when they're setting their policy rate, is interested and concerned about what's going to happen with GDP going forward. Also, even without these cuts in place already, GDP in the third quarter has come in softer than what the Bank of Canada was expecting. It's going to be softer in the fourth quarter as well than what the Bank of Canada was expecting. So these, GDP going forward is what's kind of scaring the bank right now and saying, hey, you know what, things are really going to start slowing down here. And that's probably why they were comfortable enough to go in with a 50 basis point cut today.
Okay, so I'm hearing GDP is a factor. Talk to me a little bit about what we saw in terms of unemployment.
Yeah, so unemployment ticked up to 6.8%, which was higher. It was moving a little bit quicker than people were expecting. I believe it's a full 1% from last year. Now the Bank of Canada expects it to get up to about 7% level off there and start coming back. But when you're adding the amount of individuals into the country that we've seen in the last 2 years, when the job market starts to stagnate and you're bringing in more and more and more people, your unemployment rate is naturally going to rise up. So it's not a necessary thing where, we're seeing massive amounts of layoffs. We're seeing people come into the country and there's no jobs for them. That's more or less what we're seeing when it comes to the jobs. And so when I looked at that, I had said, you know what, it's not enough for me to cut 50 basis points come December, because there's just not this mass layoff. Stop bringing in so many people if you don't want unemployment to go as high as we've seen it go. But the GDP numbers came out, and that's ultimately what tipped the Bank of Canada's hand.
Okay, so I'm hearing that GDP probably the bigger factor that we're looking at, not so much the unemployment, unless they're not considering that as well. Unless they're not considering that we're going to see, as less people come in, that number will naturally decline.
Yeah, it should naturally decline. I mean, you're bringing in 1 million people a year more, probably more, maybe 1.2 million. And then this is going to be the first time in a very, very long time, if maybe forever, that over the next 2 years, Canada could potentially go negative in the amount of people that are population growth. So this is a huge effect on how the government needs to or the Bank of Canada has to set their policy. And listen, unemployment is a very critical part, but having said that, it depends. Are there mass layoffs happening? Or are there just more people than we have jobs, because maybe we should just turn the taps off a little bit?
Right. Okay, so looking at this data that we had back on November 15th, we were seeing, likely by April of next year, and again, this was updated even previously from October, but by April, we're likely going to be down to 3%, 93% chance that's where we were ending up at that point. And now when we come forward to, wrong button for me. When we come forward to today's data, we're looking at potentially a 75% chance that we get another cut there in January, bringing us from our current, as of today, 3.25 down to 3%. Still holding, most likely, not holding, now in terms of April, unlikely to be at 3% in April, much more likely, 99%, looking at 2.75 in April. So they're still not stopping here. It's not like they're going to do a 50 and then slow down or just do the quarter and get there before we get to April. It looks like they're going to continue with these cuts.
Yeah, I think the one thing they made very clear today was the oversized cuts for the meantime are done with. They've come in with two very big cuts, and I want to make it very clear. Cuts like this are typically not done unless there's a big event. So the last 3 times that we had 50 basis point cuts, let alone 50 times 2, was the dot-com bubble, the great financial crisis in 2009, and for COVID. So we've seen 2 big bazookas hit. Now, some can argue that, the way up was quite crazy as well. So getting back to that normal, we'll need some big cuts to go forward. But Tiff Macklem came out today and made it pretty clear that from now on, expect more of a 25 basis point cuts than the full 50. So what this is telling us is we'll probably get another one in January, and we'll probably get another one in March. And then it's kind of a coin flip to see if we're going to get one more before the end of the year, later in the year. Now, if you look at RBC Economics, they're forecasting rates to get down to 2%. Now, the big banks and stuff like that, that's their own. We use this chart because it's the bond markets telling us where they think things are going to go. They're not always right either, but I tend to follow them. So I think no more big size cuts this year unless something drastic happens in the economy.
Gotcha. And so as we look at this, likely at 2.75 there in April, and then the next most likely movement we're kind of seeing around that October, where we slightly go 51% to the 2.5, and then definitely swinging a little bit higher there in December. That's where currently the bond market thinks we're going to end up. Okay. All right, let's move along to getting right into what we're seeing on the ground in terms of us realtors. We're now looking at Broker Bay, which is our booking system on the Toronto Real Estate Board. It's where we book all of our showings for our buyers, and they release data as well that we track. So going through here, we saw our biggest push for the fall in terms of showing activity in Aurora specifically, popping up there in the second week of September. We saw another little boost there towards the end of October when we got that other 50 basis point cut. And we've just been kind of maintaining and trailing off in the last week or so. And honestly, I think that's just a seasonality thing. If you're asking me what this might do in terms of large impact, this announcement for the month of December, I don't know if it's going to make a big push in the market one way or the other, just because of the seasonality of it. Everybody's got vacation plans. There's time off coming up. People have been pulling homes off the market, as we're going to see in some of our other stats. So I think that it's normal to say that we're just going to see this coast for a little bit. I think the big impact we're going to see from these rate cuts is going to be in the early start of next year.
Yeah, and you know what? Just thinking about the rate cut, going back to the rate cut, I think the reason they chose December as the time to drop another 50 instead of maybe January or in March is maybe they don't want to overheat the market by doing it in January. They want to do it in December so that people they see it, but then they forget about it, and then maybe January, February, it's a little bit softer, just to not spark things a little too crazy in the real estate market.
Absolutely. Based on our October numbers, there was that chance of more of a 50-point cut back then. And when you're looking at how the market has performed in January, February, March, the last kind of 3 years in a row, it's been the best stretch in terms of month-over-month gains. So it's a great point that you bring up, saying, hey, why do that in the hottest part of the real estate market when we've been concerned about making drops because we don't want the real estate market to take off? Let's do it in December, get it out of the way. We've got new data that shows we need to make a cut this big. Let's do it now when the market is less likely. Well, the real estate market is less likely to take off.
And listen, at the end of the day, the Bank of Canada's mandate is to keep inflation at 2%. So ensuring that, they don't fuel, housing costs, which is a driver of inflation, which is a part of the basket, might have been one of the reasons we saw a big push today.
I think so as well. Now let's pop over to Newmarket, and we're looking at the same thing, except they've kind of balanced out a little bit more in terms of coming up and showing activity in comparison to Aurora. So same thing, we saw our next big push there in the second week of September, and then another push as we get into October, and they didn't level out as much. We had a little dip and then an uptick. Newmarket's been doing pretty well in terms of its showing activity, especially in comparison to Aurora. And so it'll be interesting to see where this carries through in terms of the month of December. Just a note for those of you looking at it, this last week, for whatever reason, when we look at the analytics on Broker Bay, it always tails off. Even though it's ending prior to us recording this data, it never ends up this low. So don't be alarmed by this part. I'm anticipating it will continue a little bit more of a straight line with that little dip accounting for what December brings.
What I like about Newmarket as well is offers are up 11% year over year.
Year over year, yeah. And you and I have talked about this. Year over year is fantastic. We know that we're getting better, that the market is turning around. We've seen that in sales volume. We've seen that in pricing. And I think the important thing to note when we look at some of the percentages, as we did last month with that big headline that said sales up 40%, well, you got to remember the market, the fall market last year hit a brick wall and everything just stopped. So for all of us that are looking at year-over-year stats, or for those of you that are reading the newspapers and the headlines, some of those numbers look very inflated because of what we're comparing it to. But nonetheless, fantastic change that we're seeing. And this is where when we break down our stats as well, we're looking at the monthly change. We want to know how's the market continuing going forward. And as well, these quarterly changes are very relevant in terms of what we're seeing the market do. So down a little bit on the Toronto Real Estate Board in terms of average price. Totally to be expected in terms of the seasonality. I'm not worried about that 3% dip really at all. Sales down a little bit, again, to be expected. Any difference in opinion there, Matt, in regards to what we're seeing, October to November?
Not on the monthly. The number that stands out the most to me is the 39% on the annual change.
Yeah.
For transactions, that's a great sign to see when you look further out.
Absolutely, and as well with the quarterly change, seeing that we're doing better than we were last quarter, just in terms of our transactions there, as well as our average sale price, which makes a lot of sense. I think that the market is slowly starting to rebound, and if you ask me where we're going, I think we're past. For those people that were waiting for the bottom, it's clear to me that you've missed your chance, unless, like we talked about, unless something drastic happens next year. We've turned around in terms of our sales volume. We're officially on pace to make sure that we surpass 2023 in terms of sales, and we've seen the turnaround now in average price. So yes, will we see seasonality dips and little variations month to month? Absolutely. But in terms of a true bottom, I think we're past that. When we take a look at our average sold price, again, acknowledging our dip off last month for the month of November in comparison to where we were in October. October, we saw a fantastic increase. And just in general, our consecutive 3 months of increases in a lot of areas that we're seeing in terms of our average price. Benchmark still needs to be updated there. And transactions trailing off just a little bit. Obviously way down from our 2021 numbers, but that's to be expected. When this happened, it was unheard of, hitting 121,000 sales for the year. There hadn't been really anything close to that. So we're leveling off in something that we would, more so anticipate that we would typically see in terms of our monthly sales. And And overall for the year, we'll get back to it. We are still low in comparison to previous Novembers for what we'd expect. All right, talk to me about, well, we just kind of did sales, but same thing. This is where you're seeing over the longer stretch here, going back to 2012. And again, as you come down in the later halves of the year, you know, it's not that unexpected. You're seeing a little, these are very standard, right? This is what we would expect in a normal year. And then 2020 came along, 2021, and then of course our steep incline in rate increases, dropping our sales off like that.
Yeah, I think 2021 pulled a lot of demand forward as well.
Yeah.
And that's probably why if you go back to the front of that chart, you can see those peaks keep climbing, and then our peaks have been kind of going the other way here. And I think a lot of that has to do with just how much was absorbed probably in 2020, 2021, 2022. But that should start to reverse itself hopefully next year.
Yeah.
Just one more thing with the sales there. Sales are down 40% in the GTA year over year from last year.
Interesting number.
Last year there was 4,194 sales. This year sales were up 40% from last year, not down.
Yep. That's what we'd expect there. And then again, this is the relentless nature of the GTA housing market. Look at this graph, you know, through the challenges that we saw, this huge run up in 2016, 2017, and then the correction there as stress tests were put in, fair housing plan was put in, foreign buyer taxes were put in. So there was our correction. But at the end of the day, the trend line is still very much going up in this area. And then we've had this extreme volatility of the market the last couple years. And it's, you know, Matt, it reminds me of conversations I was having in 2021 where realtors amongst themselves, as we were holding offer nights, because it was the only way to kind of really first condense everything into a shortened time frame so that your sellers could be out of the house with the amount of demand that we were having and not that fear of selling lower than what they could have got. But at the same point, there were so many agents that were looking at it and be like, I honestly don't know where this thing's going to go, because there is so much pent-up demand that there could be somebody that comes and really blows this thing out of the water. Here's where your market value should be, but here's where the last market value should be, and somebody paid X for it, right? So there's the challenge if you're trying to buy a home in this market, and it's interesting to see that volatility over the last couple of years in this graph in comparison to what we were seeing before, at least into the extremes, right? Like the extremes weren't quite as high as we have our ups and downs going this way, and now we're getting these higher peaks and lower valleys as we're adjusting. And it just reminds me how challenging it was in those years with the amount of demand that was going on for both buyers and sellers. Sellers, yeah, they're happy when they sell, but now they got to go become a buyer. And the stress that's put on you to try and find a home now that you've sold, or vice versa. And then you talk about the people that got burnt in 2017 that were playing the game the way the market was kind of dictating, where you almost had to buy first and then sell. And the reason for that was, one, the market's going up. So if you buy here, you're technically buying lower than you're likely going to sell. But two, if you sold, you might then lose out on your next 4 houses because of the demand that was going on in those areas. And then you're left without a house, right? But then they changed the game overnight. And some people, you know, had issues, of course, with appraisals. Anyways, looking at that graph, it's just interesting to see the story that it tells.
But it also tells me a story that relates to today's rate cuts. It's when you overdo rate cuts, you get these peaks in the market that are aggressive like this. And for the most part, you draw a straight line across this chart, you can almost tell when interest rates went they were in ease rate 2% or below. And the market just gets ahead of itself. And for me, I like a nice consistent, I don't like real estate as a speculation. And the unfortunate part is most people speculate in real estate. They call themselves investors, but they're speculators at the end of the day. And they're speculating that the price will always go up because interest rates will go down. And that's why we saw what happened in 2017. That's what we saw happen during COVID. Now, real estate will always go up. It's a great investment, but there come these points when it just gets so overvalued and so expensive, and it's all because of the interest rates. And that's why I was hoping for a 25 today. They did a 50. I just hope it doesn't spark a bunch of speculation that everything's okay, because there's still a lot of headwinds to face us coming forward in the next year.
Yeah. And you know where we see that speculation is always in the pre-construction market. The amount of people using HELOCs to just put down payments, cover their deposit structure, and then they worry about closing down the road, and then something like 2017 happens, the run-up that we see here, and then ultimately the correction that comes afterwards, and these homes aren't appraising. And even with the 20% down built into it, it's not enough to help them with that appraisal. It's not enough to help them with the carrying cost of what they're getting into at the end of the day. So I agree. We always see in that really low interest rate environment, this is what we see. And we see people borrowing money because it's super cheap, putting it down into real estate because we see how great the real estate market has done for a long time, but they're not accounting for how volatile that market is in the run-up and what could potentially come after it, and making sure that they're liquid enough to be able to close on those properties as well.
Yeah, and I think a true real estate investment can be found at any time. I prefer them at this time when there's less people in the market chasing it around. You know, you can find a great property that needs some work done to it or an addition added on to it so that you can create equity in the property. And if interest rates do go down, okay, you've made some more money in the property. If they stay stagnant, well, you know what? You've added a bunch of value to the property already. Maybe you've got the rents up enough to where you're breaking even or making some money, instead of buying with just the hopes that property prices will go up $200,000, $300,000, $400,000. It's why we have a productivity issue in Canada right now, is because there's too much speculation in the real estate market and not enough money going into business in areas to actually productively grow our country.
100%. Well said. Well said. Looking at our active listings, of course, over the last couple of years, they've been trending upwards. A lot of this we've seen in the condo market as well. You know, we've seen record highs there. We've seen investors trying to dump their properties as we've had those challenges, especially with variable rate mortgages. But here we're coming into the seasonality dip, right? Coming into that seasonality dip, here we see it 2023 tapering up to the end of 2024, dropping off, and then it comes right back up. So we're following that same trend line. I expect to see this come down a little bit more after the month of December, and then we'll see where we go into the new year. Likely, it'll follow that same trend line, maybe not to the same highs that we saw last year, but nonetheless, there's a lot more coming down the pipe. We have a lot more mortgage renewals coming up, and we have a lot more people, I think, that will take advantage of the rate cuts that we're seeing. So it's hard to say what that total inventory will look like. It's still expected to come back up. I don't know if we're going to hit the same high next year. Do you have a prediction there, Matt?
Well, first off, I'll say that we're up 30% year over year. You know, I've had clients, I've talked to people who don't want to put their property on right now. They want to sell potentially in the spring market because they think that they're going to get more money in that spring market. And how many other people are thinking like that? How many other people are saying to themselves, well, we just had a 50 today. Maybe we'll get a 50 in January. Maybe interest rates will go down. Now I'll liquidate my house then. I'll put the bills on my credit cards. I'll do whatever it takes because I might get more money for my property. So I'm curious to see if that's going to be the case come the spring. So I don't know if we're out of the woods yet. This is something that's increasing right now. So we'll see. We'll see what happens. My prediction is maybe it'll be more inventory than last year for the spring market.
All right. I like it. I think the other thing to take note of as you talk about the timing, you know, January, February, the last couple of years have been the months to be out there where buyers were looking, there was optimism in the air, and at the same point, there wasn't as much inventory for you to compete against. And funny enough, March seems to be the turning point. It just, for the last couple of years, in 2022 was when the rates started to go up and we saw that change. In 2023, again, just tapering off a little bit. 2024, prior to March, we had seen multiple offers working again. At the start of this year, multiple offers were a very busy thing in January and February. Come March, you start to see the cancel and relists roll in. It's not to say that in, March, April, and May, you're not benefiting from some of the higher average prices. There was a little bit of a run up that, arguably, depending on the pocket you're in, you would either see maintain or trail off. But nonetheless, the competition that was out there was essentially starting to taper off by March. So it's interesting to see.
One other thing that we're going to notice a lot in these charts going forward is a lot of people are taking their property off the market right now, starting in November, and they're going to relist it in the spring as well. Like, we'll see in those charts, but that's not factored into where real active listings should be if we were maybe a month or two prior, maybe if we were in September. We're in December now, so of course some of these things are going to drop off, but they're all going to go back on the market, I would suspect.
Yeah, and you can see us coming down from the peak there in terms of our active listings. New listings, same thing. This is a big reason why the active listings are dropping as well. We are not seeing as many people entering the market right now. Typical for the time of year. Nothing really there that surprises me. Totally okay with that. Months of inventory, yeah, ticking upwards. Ticking upwards. This is kind of surprising that it's, Treb does typically use a rolling average to help correct for that seasonality, as we've seen new listings start to drop off and people pull their home off the market. So that might be why for the month of November we didn't see as big of a drop as you'd expect here. What are your thoughts on that, as this hasn't necessarily dropped as much and we're still sitting around 3.3 on the Toronto Real Estate Board?
Yeah, if we go back to 2017, that's the last time we bottomed out, and then we saw the rise. Now, typically at the tops of these, when they roll over, there's a nice flat spot, which kind of tells you that, hey, we're starting to roll over here. And I just haven't seen any of that since 2022. We still keep moving and peaking. Maybe we're making a flat spot right now and we'll start to see a rollover, but this is the highest months of inventory trend that we've seen since at least 2011.
Yep.
And this is a worry. And what's the catalyst to make this go lower? Interest rates are still higher. Sure, maybe in a year they'll be another percentage point lower, but there's still going to be people that are affected by that. So I still think we have got a little bit more room to the upside before that changes. Maybe at least another six months or so.
Yeah. I don't disagree at all. Talk to me a little bit here about our charts for our interest rates as we move through this, the bond market, and again, unemployment.
Yeah, so I was talking earlier that big rate cuts are typically not seen. So if we go back to 2008, we can see like a lot of these were just 25 basis points, and then all of a sudden we started to get 50 basis point cuts during the financial crisis. And then we saw that again during COVID, where it was almost straight down to the lower bound rate. So, we are seeing these oversized cuts. Now, it could be just because of how high we are relative to where we've been in the last 15 years. Mm-hmm. And we can still see, even with those big cuts, we're still as high as we've been since 2009 for variable rate mortgages. So we still have quite a ways to go just to get down to where people have normally seen their rates over the last 15 years.
That's a great point, and I think I love that you bring up the other world events where we see these kind of cuts happen, and the foreshadowing that unfortunately comes along with it, or just the litmus test of where our economy is when we see those kind of cuts. And I'm distracted here as I look at the way up that we saw with that 75-point increase, back in 2022.
Yeah.
And it's drastic. So when you're just looking at this chart and you're putting everything else aside, it's kind of comfortable to say, well, we might need big ones to get back down.
Yeah.
But what we've talked about before and the volatility that we're seeing in the market is, as you mentioned, they over throttle, then throttle down really big. There's no consistency, and it's kind of jarring to the market, right? And I think that if we get back to something that's a little bit more showing stability, like coming after 2017, it wasn't drastic as we're trying to change things around, right? But this time, it was just such massive jumps that obviously impacted so many people, really slowed things down. And I'm just wondering if we're overcorrecting on the way down or if it's going to be all right.
I mean, listen, at the end of the day, we're still extremely high compared to where we've been in the past, but we also don't want to just flare a market up and cause inflation to come back. We want to get to a nice neutral bound, which I believe is going to be around the 2% area. Let's not forget, listen, in 2018, when we started to raise interest rates and we finished up around the 2% mark, the market puked that back up and we had to drop rates again. We started dropping rates right before COVID because the market was like, these rates are too high. We do have to get down there. It's just how we get down there, how quickly we get down. I fear that if we go too fast, too much, it's just going to spark excessive demand in the market again. And we need to get to a point where people realize, hey, you know what? Maybe we need higher rates that are more sustainable so that people stop using real estate as a speculative asset and other types of investments as well. Because I just feel like ever since 2009, we have 3 low peaks. And what has happened in all 3 of these lower bound rate cycles is excessive speculation. So I'm hoping that we can find the 2% range and be able to actually invest money wisely and get real returns for it and not speculative returns.
Beautiful. Okay, talk to me about the bond market as we've seen kind of a little uptick recently. We've seen them trend down a little bit, especially as this impacts now our 5-year rates, which is great because all those people that are refinancing, a lot of them prefer 5 years to working with variables. But even after some of our announcements, we've seen a little uptick. So what's going on there?
Yeah, I mean, we've been kind of bouncing around up and back and forth since 2022 at this range that we're at. For the most part, the interest rate was pricing in around 3%, and then we got the extra 25. So we're sitting at 2.88. I think, like I always like to look at this to try and gauge when the next moves in the Bank of Canada. And the Bank of Canada looks at some of this as well and makes decisions. But it's sitting at 2.88. I feel like if we were going to get bigger cuts coming forward, this market would have been moving to the downside already.
Okay. And talk to me about unemployment.
Yeah, so we touched base on it earlier. We can see, we were at the lower bound around 5%. Now we've come up over the last couple years to the 6.8. Still lower than some of the peaks that we've seen in the past. Mm-hmm. If we go back to the 80s, we were up in the 13% range. I don't foresee us coming anywhere close to that. That's back when interest rates were 18%, 19%. That's when we really had some crazy inflation that needed to be under control. And sometimes job losses, in a lot of the cases, job losses are needed to get that inflation under control. Are we getting some job loss? Yes, but how much of this is because of our booming population just not being able to find a job? I don't know the numbers of that. Maybe they exist out there, but I haven't seen them. The Bank of Canada says we're going to round out around 7%. And if we go back, that's kind of where we were in 2016. And, the economy felt like it was doing pretty good in 2016. So I would get more worried if we start getting up around the 9 or the 10. Then that's what we saw back in 2009 after the financial crisis in the U.S.
Yeah, it's funny. It seems like it's always a moving target, right? It's either always, it seems to be like working its way down, and then there's steep inclines. Work its way down, steep incline, right? Yeah,
and that's the force of drastic rate increases can have on a market.
Yeah. All right, let's start getting into our actual housing market and what we've seen change when we and Matt put this together, we're always looking at month over month because we want to see how the market is changing moving forward as opposed to some of our comparisons to previous years. And now when we're taking here a look at York Region, across all home types, our median sale price did take a little bit of a hit last month. Again, that's in line with the Toronto Real Estate Board as a whole. I'd say seasonality to be expected. Sold listings, same thing, down that 6%. New listings, Matt, this is what we're talking about with the seasonality. Not as many people are putting their home on the market now going forward, and we'll continue to see that that decline as we move into the month of December.
Yeah, I mean, sold listings down almost 8%. So active listings are down 14%. It's the new listings coming on, or people just aren't listing because of the seasonality, but a lot of people are taking their home off the market as well. And we're going to see that a lot through these charts, as most places are going through that, except for some places in Simcoe. I don't think they got the message. They're actually seeing a reverse where they're actually getting more. So we'll jump into that in a bit, but yeah.
Yeah. Interesting to see that, of course, our months of inventory is declining because even with, the sold listings dropping, our new listings dropped by an even higher percentage. So ultimately, months of inventory declining a little bit. So those that are out there and that need to sell, it's a little bit easier for you now as there's a little less competition coming onto the market. When we take a look at York Region as a whole and break down our change through price points, you can see our months of inventory there relatively hanging pretty low until, of course, you get to that 2 million mark. We're now up to 7.7 months worth of inventory there. And again, year over year changes in pretty much every bracket looking pretty good. Bigger increase there in terms of sales volume from our million to 125. Makes perfect sense. And as we climb up, even at the 2 million mark, we did see an increase in sales volume. So nice to see for York Region as a whole. Coming over to Aurora, we saw a little bit more of an increase actually in terms of median price in comparison. And I've pulled some other numbers here about Aurora, which is quite interesting because I got to say we're now at our third consecutive month of sales growth for Aurora as a whole. 75 sold listings. We're now at 5.6% month over month. New listings, again, less people are listing their home right now. We're down 20% there. Days on market increasing a little bit. That's interesting to see. So I think the stuff that's sitting around is still there. The stuff that's been selling has been moving nicely because we have seen sales happen. So those that are overpriced are now sitting on the market longer. Our months of inventory declining as we've had less new listings hitting the market. Same active listings down. And now I want to jump in here, Matt, and just talk about some of these price categories for Aurora. When you take a look specifically to me, the 125 to 15 and the 15 to 2 mil, and you look at our blue bars representing last year's sales for the month of November compared to our red bar, our 2024 November sales, big increase in those brackets of basically everything from 125 to the 2 million mark, is up. And it's interesting to say as well that the average sale price for a detached home in Aurora is now $1,846,558, and we haven't seen that number since April 2022. So the detached housing market on average, again, this doesn't tell the whole story, but has made quite the rebound, and we haven't seen that everywhere else. And before I throw it to you with that information, I want to talk to you real quick about the townhome market, because you're seeing less increase there at these price points, right? At our million to 125, even a drop off in the 800,000 to the million mark. That makes sense. Our average price has gone up again. It's hard to get freehold homes under the million mark, but we peaked out for the average townhouse in Aurora at 1,312,000, and we're currently sitting at 1,091,000. So lots of growth for them to get back there. It hasn't rebounded the same way that the detached market has, which is interesting to note because I look at that and I think that still just holds true for people that don't have as much equity in their home. They haven't been able to jump back in the market yet with these high rates. And I don't know, what are your thoughts there as we look at these price points seeing gains, but specifically the detached market making a big comeback?
Yeah, I think you know what, Aurora is an area a lot of people with money want to live. And there's kind of a tale of two tapes with the people in our society right now. Is when you own quality assets, you can go out to Aurora and buy the nice house, the nice detached house for what it's at, and that's what we're seeing here. We're going to see a lot of other areas where these numbers don't look anything as close to how well Aurora is doing. You would expect that if we're cutting interest rates because the economy is about to fall off a cliff, well, Aurora is telling me something a little bit different here.
Yeah.
And why is that? Well, you look at asset prices like the stock market and other things like that, they're doing quite well for themselves. So I think that's what Aurora is telling me right now is that the upper bound of the population that controls a lot of the wealth is still doing quite well.
Yeah, I'd agree with that. And I also got a new report there that came out from MPAC that listed Aurora as the seventh municipality, ranked seventh for largest new construction homes based by square footage. So we are building big homes here in Aurora, the seventh largest in terms of like a median square footage in terms of new construction from 2020 to 2024. So it is a small town that's kind of stuck between two bigger areas. There's only so much space in it, and you're right, it does kind of have those affluent areas. And now we're continuing with that. We're building bigger homes as opposed to smaller stuff here. So I think that when you're looking at pricing overall in Aurora, that's going to be the tail that you're going to see. And
I mean, 6.5 months of inventory and $3 million plus. I don't think we're going to see that anywhere else in the charts today. Yeah. Of as tight of a market for even over $2 million to see anything that close is it's quite remarkable. It's a very sought after area, and people with money, that's where they want to live.
Even seeing that increase in sales year over year from 1 to 4 at that $3 million range is pretty interesting to see. Like 4 sales in a very luxury market last month in comparison to what we saw the previous year. It's just interesting to watch. Popping over to Newmarket, why don't you take this one away for us, Matt? Because I'm seeing just again, slight seasonal tailing off there in median price.
Yeah, we're below $1 million for the median sold price, which we haven't seen in Newmarket for quite some time. Sold listings were up though, and we've talked about this over the last couple of months. Newmarket's had some good numbers in terms of sales in the area, so that trend still continues. We're seeing a lot of demand in Newmarket. New listings down almost 28%, which is what we're seeing in most places. Average days has ticked up to 33 days or 27% increase. But oddly enough, the months of inventory is down. Well, not oddly enough, it's down 2.4 because active listings is down to 218, which is down 22%. So with Newmarket, we're seeing that big uptick in sales and active listings dropping off the board, which is cutting the months of inventory down quite a bit.
Yeah, and now when we take a look at our pricing brackets, again, seeing that year over year growth from our 2023 to 2024 numbers, it's really only just leveling off as we get to those higher price points, which is impressive, but still going quite strong, right? And low months of inventory from our 0 to $1 million, of course, $1 million to 125, still below 2 months of inventory, 125 to 1.5 still low. Like, I mean, granted, we are looking at some smaller price brackets, right, or some lower price brackets, but nonetheless, still looking fairly competitive as an overall for how bad we've heard the market can be, right?
Yeah, no, Newmarket's holding up quite well as well, and across the board, either having more sales or matching what we had last year. Months of inventory down below the 2% for anything under 1.5 million. No, they've held up. Newmarket's held up very well.
Yeah. And again, the difference as we compare Aurora to Newmarket, neighboring townships there, when we look at our highest price point here, we're looking at 2 million instead of 3 million, and we're sitting there with 15 listings with only 1 sale above that price point. So again, not quite apples to apples in terms of the comparison, but seeing that same growth in actual sales volume, and Newmarket, in fact, holding up better in terms of their months of inventory in favor of sellers at the moment.
Mm-hmm.
All right, EG, big increase in terms of median price, Matt.
Yeah, big price increase there, 22%. I think, like we've said in the past, East Gwillimbury has Sharon and Holland Landing. I suspect that, some big homes sold.
Yeah.
Because we only had 43 sales, which was also down 10%. But we likely just got some larger homes that sold. That's what drove up the discrepancy in the price. New listings were down 36%. Average days on market were up 41% to 41 days. Months of inventory, again, down 10% because active listings is down 19% at 159.
Yeah, makes a lot of sense, and it's important. That's why you have a realtor that is local to the area and knows what's going on to be able to look at this and say, hey, I know the two pockets that we're talking about. We're dealing with two very different home types and price brackets even, why you might see such a big increase in terms of a month over month when we're looking at our median sale price. Because looking at our brackets, it's funny, big decline there in the 750 to million mark looking at year over year. Which is opposite again of what we've seen in some of our other areas. But then we get back to our million to 125. You've got a big increase year over year. Months of inventory still low, but not nearly as consistently low as what we saw in Newmarket as we move forward, as we move north a little bit.
Yeah, and even the 2 million plus at 4.2 months of inventory. I lied when I said Aurora might be the only one. They've held up quite well for their 2 million plus. And, from doing the charts for the majority of the year, we've seen that for the most part, anything over $2 million in a lot of these areas has really struggled this year to see any traction. And it's been very surprising for November to start seeing that upper bound price range is actually starting to get traction again.
Yeah, absolutely. All right, continuing over to Georgina, stability in our median price. Not much change there at all. Slight change in terms of our month over month sales, which is a great sign. New listings continuing the trend of people not listing their home as much this time of year. Days on market upticking just a little bit. Months of inventory, which is oddly enough increasing a little bit as we've seen active listings come down, new listings come down, but not enough sales, I think, to help clear out where we were at. Yeah, with only 55 sales, I think there's our difference maker.
Yeah.
Taking a look into our charts, again, great growth in comparison to last year sales-wise, but really stutters after the million mark. Not much going on in those brackets. A little bit from the million to 125, not bad, but we're already at 4.5 months worth of inventory there. So not bad for Georgina, but I'd say everything under the million is where we're seeing the activity.
Yeah, I would say the 1.25 to 1.5, the months of inventory is not correct there. It should be probably closer to 20 months of inventory. So we are seeing, anything over 1.2, definitely sitting on the market. Georgina's just, you're up the highway a little bit further at the end of the day. You're not, as central as Newmarket, Aurora, Richmond Hill. So there's a lot of rural properties in here as well. So they'll take much more of a price hit, and that's why we'll see those ones stick on the market a little bit. But it is good to see that anything under $1 million is now under 3 months of inventory. So anyone out there selling right now over the next at least December, January, maybe February, you're not going to have a ton of competition, and now's the time to really try and get your property sold, because what we've seen with Georgina and with Simcoe for most of the year is, these numbers have been a lot higher for months of inventory. There's been a lot of competition in the market.
Yeah, and I think what else I see here as the months of inventory are lower in these brackets, this is where we're going to see some continued price growth, especially when we come into the spring market.
Yeah.
All right, talking Richmond Hill, bigger decline there in terms of median sale price. Our sold listings, again, not having the same impact as what we saw in some of the other areas. New listings, of course, down. Average days on market down just a little bit. Our months of inventory ticking up as we haven't seen as many sales in our month-over-month book. Active listings down a little bit as well, but not enough to offset the sold listings and new listings coming out. So it's interesting to see. But yeah, nonetheless, decent job there in terms of all home types. And I think this is where we continue to see the impact on Richmond Hill, especially changing from, this slide is all home types. To be clear, this side is focusing just on the condos. And it's the condo market that is impacting these overall stats so much, because the condo market has remained sluggish there. We've seen sales continue to decline. We're at down 16% there in Richmond Hill. Slight decline there in median sale price. It's been hovering around those low sixes now for a while in terms of median price. New listings down, days on market upticking a little bit, and our months of inventory just slightly ticking up. No big surprise there. But nonetheless, it's that condo market, when we look at all home types, where we see the greater impact. And it's interesting, some of the previous municipalities that we're looking at, they don't have condo markets that are as big as Richmond Hill and our further south municipalities. And I think that's why some of them, as an overall number, when you're looking at them, have done so much better, because they're not impacted as directly based on that condo market.
Yeah, and they're primarily detached homes, so for the most part, and so that will skew those numbers for sure.
Yeah, absolutely. Markham, similar story. Our median sale price there has been hovering a little bit. Our sold listings are down a little bit more drastically here in a month-over-month basis, down 20%. New listings down, not as much as we've seen in other areas. I venture to say there's been a few more cancel and relists when we're looking at Markham in comparison. Average days on market dropping a little bit because of those homes that have been pulled off the market. Some of them that were up there and ready to expire, same thing, coming off the market now because they've been listed since September. So you're going to see those start to roll over as well. Months of inventory upticking, and that's that condo market. A lot of condos in Markham where we're seeing that same impact. Simcoe. Matt, talk to me about Simcoe and this slight decline there in median price.
Yeah, I mean, we've seen Simcoe get hit pretty hard all year. So another month over month at 2.31% is substantial. Your sold listings are down 7%, new listings down 17% at 1,432. Days on market came down, but it's still at 42 days. Which is substantially higher than most other places that we've seen. Your months of inventory are sitting around almost half a year. And that's up 13%, because why? Active listings is up 5%. And in most other areas that we've seen, active listings have come down as people have kind of pulled away. So the fact that people aren't pulling their properties off the market in Simcoe has me wondering, how much more desperate are they that they need to move their property compared to some other places? Because at this time of year, we should see the pullback starting to happen. And to be honest, to see an actual increase of 5% is surprising.
Yeah, fair enough. I agree. When we take a look at the brackets here, we've seen that increase, especially in the sub-million mark, but not to say that it didn't happen. Wow, actually really goes all the way up to 1.5 and above. Big increases year over year. And as we see that the month actually didn't do that well, I think that's a bigger testament to how hard Simcoe got hit last fall, because that's a big drastic difference. If we're not seeing huge gains month over month, it's interesting to see how we're seeing these huge gains in the year over year for Simcoe.
Yeah, it's a good thing. It's good to see that at the lower bound they're starting to see some growth in the sales year over year. But this is a market that's really gone through the motions of the high interest rates, and I think Simcoe is getting very close to leveling out here. I personally think it's a fantastic place for first-time home buyers to be looking. You can actually find an affordable place that makes sense. Yeah, it's further up north, but if you do work from home or you can get a job local in the area, it's a fantastic option.
And look at the amount of options you have under the $750,000 mark. 663 active listings in the freehold category. And it's still hovering at 2.1 months worth of inventory. right? I think Simcoe is, again, in the new year, I think that category in particular is poised for the most amount of growth. And so if you are looking for something affordable to buy, and you've acknowledged now that we have passed what the bottom of this market is going to be, we're going to, of course, see those seasonal adjustments. We're going to see some minor month-over-month variations, but we are definitely past the bottom. What a great time to get in there into Simcoe when you have so many options still available, while acknowledging, hey, the market is still a little tight, 2.1 months worth of inventory at that price point. As you go into the more luxury side of things, again, there's still a lot of stuff available with not a lot of sales. Our months of inventory tracking quite high there. But nonetheless, as we look at all the other municipalities, we're not seeing this amount of months of inventory through these brackets. You got to remember Aurora Newmarket, we're seeing generally staying a little bit more lower, covering around that 2-month mark, 3-month mark. We're already up at 5 months by the time you hit $1 million.
Yeah.
All right, coming here into Barrie, Matt, talk to me a little bit about this median price just dropping a little bit down that 5.44% and what we saw in Barrie last month.
Yeah, price is down 5.44%. Pretty decent little month-over-month decline for Barrie. Sold listings were steady, which is a good sign. The new listings were down 22% at 432. 34 days on market, so it did take a little bit longer to sell. And we saw the months of inventory down to 3.8 months, which is still a little bit there. But I think one of the main factors for that was that active listings were down 7% to 732 for the month of November.
Yeah, our sales seem to hold fairly steady with only a minor variation there. Of course, we talked about a lot seasonality. Less people are listing their homes right now. We saw a big decline there, 22% in terms of new listings. Makes total sense to me, like you're talking about active listings coming down and, of course, our months of inventory. Let's jump into our price brackets. Looking at our brackets and where we're seeing a lot of stuff, low inventory, and again, below the 750 tail of Simcoe as well. And then a much bigger incline in terms of month of inventory. Once you hit that 750 to the $1 million mark, we're already at 4.7 months worth of inventory. Lots of options here for buyers. Lots of options in terms of what you can buy here in Barrie. Not, of course, now we're looking at Barrie as opposed to Simcoe. Only 134 available for sale under that 750, 248 as you come over the 750 to stay under the $1 million mark. So not bad, and then of course a lot of choice there between the $1 million to 125. Good opportunity for buyers to jump into the market. Yeah,
I like Barrie. I like Simcoe. I think, like I said before, for first-time home buyers, I think it's a good option to get your feet in there, and you got to start somewhere at the end of the day. And as long as you don't work too far from Barrie, it could make sense for you.
Yeah. 100%. Coming over to Durham, slight increase there in median price. Sold listings declining quite drastically. New listings coming down. Average days on market upticking just a little bit. Low months of inventory out in Durham. And we've talked about Durham throughout the year. Has had some really fine moments where it was really shining. So it's interesting to see that they are still doing so in terms of the inventory levels. Not a bad time for sellers. There's some minor variations there, but ultimately you're not dealing with the same amount of competition, let's say, that we've seen in some other regions. Pickering holding true to that as well. Months of inventory down at 2.2% or 2.2 months. And I want to highlight that because, again, for sellers, great opportunity to be out there and not have a lot of competition in comparison to some other municipalities. Median price down just slightly, talking about that seasonality. Sold listings down a little bit. That's a little different. We have seen in certain areas sold listings upticking just slightly. Everybody's a little bit different. Nonetheless, new listings coming down quite drastically, on par with the seasonality of it. Less people decide to list their homes now than you would otherwise. For the fall, we're typically looking at that September, October. If you miss it, it is what it is. Perhaps you made your purchase there, but nonetheless, it's a tough time to be on the market historically in the month of December. So you're either clearing out or you're not listing right now. That's what we're seeing there. Days on market down 24 days. It's looking competitive for the sellers in in Pickering. They're looking like they're in a good spot. It's competitive for the buyers amongst each other.
Yeah.
Vaughan, looking at Vaughan, down a little bit in terms of our median sale price, just slightly. Here we have seen growth in the sale department. New listings with that seasonality, of course, still ticking down low, down 24%. Days on market upticking a little bit. And I think what we're seeing here, as we see less homes entering the market to offset our averages in terms of days on market, we're still left with the homes that haven't been able to sell, perhaps some that are a little bit overpriced. That's why we're seeing our days on market upticking, while at the same point, our months of inventory are declining because the amount of new listings has come down so much. And that is it for today. I'll slide back so you can take a look at Vaughan as we exit for today. Matt, I think today's 50 basis point cut, that announcement from the Bank of Canada, is no doubt going to have some impact on the housing market. We still have a lot of other indicators to look at. I think for the month of December, we're not going to see too much of a drastic change. Like you and I talked about, I have a strong feeling that's why they did the 50 basis cuts now, as opposed to in the spring, where they're worried about the housing market heating up. I think what's most important for both home buyers and home sellers is to start making your plans now. Make sure that at least by January, you've got a strong plan in place. If you have goals to meet for the year of 2025, there's so much stuff going on in the housing market. If you don't have a plan, you're going to miss out on opportunity. Of course, that's not to say that you have to move in the spring or you have to buy now. It's none of that stuff. It's about making sure that you've got a great plan. Like Matt said, I believe that there is always a great time to buy the right investment property. It's when we get into these hot markets that people are speculating, that people get hurt and bad mistakes get made or poor decisions get made. So a strong plan is what it's all about. And I think what a better time to do that, in December and January to start having those conversations.
Yeah, I think ultimately a lot of people don't have a plan in place and they just jump right in at the wrong time and they make a rash decision. And I think when you do talk to a professional and you lay out a nice solid plan, it's going to better position you for your future.
Yeah, absolutely. And as we break down these numbers, we can already see some opportunities that are out there. Areas that aren't performing as they should, places where you have a lot of inventory to choose from. If you're a seller, we've seen a couple of pockets that have great low inventory right now. And again, as we talked about what might happen in January and February, historically, and by that I mean the last 3 years, like very relevant times, they've been some of the most competitive months in the real estate market. And likely to say we might see that continue going into 2025, but every market's different. It's important to make your plan. Matt, thank you so much for joining me today. I love doing this with you. I look forward to seeing you again in the new year as we roll through the new data that comes out.